2024 is shaping up to be an interesting year. Our outlook is that growth is going to slow materially from 2023 as the fiscal stimulus from COVID has largely been spent down. As for inflation, we expect inflation to continue to grind down to the Fed's targets over the coming couple of years. And that sets the stage for the Fed to begin to normalize interest rates. We think two things are important. First, at these starting yields, we think it's a wonderful opportunity for investors to engage in the bond market. Many investors have sat on the sidelines, parked in cash for the past 3 to 4 years. The yields we're looking at today are the most attractive they've been in perhaps 15 to 20 years. For instance, if you look at core and core plus bond funds, today's starting yields are in the 5.5% to 6.5% range, and high-quality multi-sector credit funds are closer to 7%. Those yields are not only attractive on an absolute basis, but we believe they're attractive versus other higher-risk assets like equities. And earning that yield on these funds is just the start of the story. There's opportunity for capital appreciation. Eventually, at some point over the horizon, as inflation comes down, the Fed will normalize interest rate policy, and you'll not only earn that yield, but you're likely to get capital appreciation from the duration you've added and the roll down of the curve. Second, how investors access the bond market is important. While in the equity market, passive indexing may work, bonds are different. In active equity funds, history shows that only about 30% of managers beat their passive peers net of fee. Whereas core and core plus bond managers in the active space, roughly 80% beat their passive peer net of fee. In the economic environment we're in right now, and likely to be in for the next couple of years, we believe uncertainty, volatility, and dispersion create a potentially attractive environment for the active bond manager who can be flexible and nimble in their portfolio management strategy in their pursuit of alpha.